Hey everyone, welcome back to the channel. And today we're diving into one of the big questions on every investor's mind. What's next for the stock market in 2025? We just had a really strong 2 years in a row, and with macroeconomic factors shifting. The question isn't just if we keep rallying, but how, where, and what risks are hidden ahead. So in this video, I will walk you through four major areas. The first one is a recap on how the market got here. The second one, what are the Federal Reserve, the Fed, and interest rates policy doing and what that means. The third one, valuations and the key indexes, especially the S&P 500 and how that might impact future returns. The last one, the structural themes, especially tech, AI that could carry the market forward, but also the risks to watch. And at the end, I will share my own outlook for 2025, where I see opportunities and where I'm cautious. So if you're investing, trading, or just trying to make sense of all the noise out there, this will help. And let's jump in. So the first session, the 2024 and entry into 2025. What is the backdrop? And this is the chart of the S&P 500 ETF. And the ticker is SPY. It's currently trading at 671 US dollars. And as you can see, over the last year, it yield a 14% return, which is amazing. And why did it rally? Here are a few key drivers. Inflation started to moderate and more confident that the Fed wouldn't need to keep hiking at the pace it did. Earnings growth picked up. Tech and growth sectors dominated. A supportive macro environment. Growth held up better than expected. Consumer spending remained resilient. In short, as we move into 2025, the market entered on a strong burst up. But that raises the questions. After a strong run, can the momentum continue? And if so, under what conditions? Yes. Next, the second section, Fed, interest rate, and the key lever. So what we have on the screen right now is the 30 years fixed rate mortgage average in the United States. And as of October 2025, it is a little bit over 6%, which is amazing. So the interest rate affects valuations, cost of capital, and investor sentiment. And the Fed has signaled that after the aggressive hikes, it is moving towards a pause and potentially some cuts depending on inflation and employment. For example, one source suggests we may see two more 25 basis point cuts by year end and possibly another 50-point cut into 2026. Why does this matter for stocks? Because lower rates mean cheaper borrowing for companies, less pressure on profits, and they make future profits more valuable due to the counting. However, the risk is that if inflation remains sticky or the employment market stays too hot, the Fed might not cut or might even resume tightening. That would dampen stock valuation. And the bottom line is the market is conditionally optimistic on rate cuts, but that optimism is hinged on inflation and jobs staying on a manageable path. We'll move on to the third session, valuations and what they imply. So on the screen right now is the Shiller PE ratio, which also is the cap ratio. So why do I want to show you guys this chart? Because this chart will tell you if stocks is expensive or cheap. So the high Shiller ratio greater than 25, stock is expensive. A low Shiller ratio below 15, stock is cheap. And how do they calculate this PE ratio? It's use exactly the same formula for individual company, but they use the earning of the S&P 500. So we have a broader picture of what's going on. So many strategists point out that the US equities are at elevated valuations. For instance, the price over earnings and other valuation indicators are well above long-term averages. One paper showed that even when valuations are high, return can be positive if earnings growth continues. But the risk for a meaningful drawdown also rises. For 2025, firms like Morgan Stanley suggest that the year could be a pause year, meaning modest gains rather than another blockbuster. So, what's the takeaway for investors? If valuations are high, growth becomes more important. Can earnings live up to expectation? And downside protection matters more than in cheap valuation environments. Next, the structural themes and sector leadership. So when I say theme, that means that what drives the price of the market. And as we already know, these are AI, booming tech company, and that's the reason why the markets have a big push up in the last 2 years. So now we dive into one of the biggest themes, the AI. So the push into generative AI, data centers, semiconductor demand, and all this generating assignment and investment related. The growth stocks have outperformed value stocks recently. Now small caps in other sector might get more attention if they're in rotation. On the flip side, as powerful as the tech AI theme is, it raises some risks. For example, concentration risk. Few stocks doing most of the heavy lifting and the possibility that hype outpaces real earning. Beyond tech, so look for broader participation. Sectors like industrial, infrastructure, energy, and perhaps international markets might come back into focus if the macro environment shifts. Thus, the market in 2025 might not just be about buying more tech, and ignore the risk. Is my reward partner breathe along with stocks that can deliver? My view, what I am watching the risks, inflation surprises or wage inflation resurgence that would force the Fed to hold off on cuts or even hike again. Earnings disappointment, especially in high-flying tech AI names, if execution doesn't match expectation, we could see a correction. Geopolitical trade disruptions. These have often been underappreciated in crowded markets. Valuation shocks. When valuations are elevated, corrections tend to be sharper. What I am inclined to do, opportunity. I believe we can still see gains, but I am expecting a single digits to low double digits returns rather than 20% plus. Be disciplined with entry points. With valuation high, I am waiting for pullbacks or better value zones to increase exposure. In summary, I will stay on the sideline until we have a clear picture of what's going on. If we do have a correction, I will wait until we start getting back to the most recent high and open a new position.